Hello and welcome to our Taking Stock episode for the week ending the 8th of August 2025. I'm Trinh, Head of Research at Stock Doctor, and joining me today is our equities analyst, Charlie Song, to strengthen your all things share market. Well, Charlie, with reporting season here, things are certainly picking up, especially in the sectors that you cover across those REITs and retail.
Yeah, they are picking up, and we'll see it pick up further next week.
Yeah, definitely, especially that retail space where we've seen some downgrades already coming through over the last couple of months. But as always, the information we share today is of a generic nature and doesn't take into your account your personal situation. So shares are volatile, so any past performance figures aren't a reliable indicator of future performance. Well, Charlie, markets continue to kick up pretty strongly in August, and that was driven by hopes of a September interest rate cut after US July jobs data came in softer than expected. While here in Australia, markets are all but factoring a 25 basis point cut by the RBA next week. And this has helped support also gold prices and gold miners because other high yielding assets like bonds and cash, they become less attractive relative to gold. Also supporting the precious metal this week is this ongoing tariff uncertainty, with Trump now signaling that he would increase tariffs on India to penalize them for importing Russian oil.
Yeah, and let's not forget we are now in reporting season, and with valuations already quite elevated across many stocks, earnings expectations are relatively high. That makes it crucial for investors to manage portfolio risk. As you can see with the chart on screen, share prices, which are in blue, have rallied well beyond the trend in earnings, which are in black.
Yeah, that divergence there is quite stark there, Charlie, but that's why it's important to stay diversified and hold at least 15 stocks in your portfolio and avoid prematurely adding full positions to stocks without really understanding how they will report and what their financial health will be. But reporting season is about those fundamentals, and you need to confirm them or otherwise they'll be challenged. So let Stock Doctor help guide you on those calls. But let's now turn our attention to a few star stock highlights for this week. The first off the ranks is automotive software business, Infomedia, the code is IFM. They received an all-cash takeover bid from private equity group TPG Capital for $1.72. That's a healthy 30% premium to their prior close. But the share price, it's recovered, but it seems to be trading where it used to be.
Yes, and the offer highlights the progress IFM has made in the past 1.5 years. The business has improved its return on equity and its net profit margins, which now sit at a healthy 17%. The business is expected, at least on analyst forecasts, to maintain these strong metrics with revenue growth guidance of 3%.
Yeah, those return on equity metrics are quite strong. But IFM, they do play a critical role in automotive after sales software, parts catalogs, service quoting, and diagnostics. And despite this, its share price has lagged in recent years, and that was due to technology integration delays, management changes, and broader concerns about the outlook for the automotive sector.
Yeah, and that disconnect has made it a candidate for a private equity takeover. That's especially given that it has received multiple bids from investment firms in the past. The board supports the deal in the absence of a superior proposal, with a shareholder vote scheduled in November.
Yeah, and given where the share price used to trade at, it does seem like quite an opportunistic bid by private equity. But one issue that popped up during the week was the ASX. They accidentally released the announcements under TPG Telecom's ticker instead of TPG Capital. And that sent the unrelated telco down 5% before trades were reversed. It was a strange moment there, but it does raise concerns about the process integrity at the ASX stock exchange, especially at a time when transparency and investor confidence are critical during reporting season. Nonetheless, though, the government is also considering support for greater competition in this exchange space. And together with the regulatory scrutiny that these guys are under, it does pose a threat to ASX long-standing market dominance. So it wasn't surprising to see the share price of the ASX plunge this week as well. But moving to the resources sector as well, Charlie, let's start with diversified mining Rio Tinto. Now, following a review of its first half result, we did decide to remove it from our star income stock portfolio, but that's pending the release of its dividend when it goes ex-dividend on the 14th of August. The main reason here does appear to be that free cash flow that is forecast to fall below dividends over the next 2 years.
Yeah, and capital expenditure is expected to accelerate in the second half, with Rio Tinto guiding for $11 billion in full year capital expenses, implying over $6.3 billion to be spent in the second half of FY25 alone. This lift is going to be driven by ongoing investment in key growth assets, including Oyu Tolgoi and Simandou.
Yeah, and just a reminder, free cash flow is the amount left over after capital expenditure is taken into account. But over the half, its return on invested capital dropped from 23% to 19%. And that's above our tolerance for star growth stock status. However, we did transition the stock to our borderline star growth stock portfolio because Rio does have several energy transition avenues, especially towards copper, aluminium, and lithium, with prices for lithium anticipated to recover next year.
But iron ore is still the main story here, isn't it, Kien?
Mm.
Accounting for around 60% of underlying earnings. That's a risk in today's environment, given China's weakening construction activity and the potential for increasing supply, including the production uplift from Rio's own Simandou development. Although its dividend yield appears attractive at 4.8% with added franking credits, the margin is insufficient to compensate for the risks, in our opinion, of volatile commodity prices and rising capital expenditure.
Yeah, certainly a few risks there. And adding to that is this leadership uncertainty with incoming CEO Simon Trott aiming to simplify the business instead of scaling it up as well. But positively, also, we noticed that short interest on the stock, that's been trending lower, but does remain above that 5% threshold. So we'll still be watching this stock quite closely.
Yeah, and with the reporting season heating up, there will be a few big star stocks releasing their results next week. That includes Commonwealth Bank, Computershare, Pro Medicus, Endeavour Group, Cochlear, and Telstra. For full details, please refer to our corporate calendar.
In Under the Microscope this week, we take a look at online property platform REA Group, which once again has proven why it trades at a premium valuation multiple relative to its peers. The stock did rally by around 6% after meeting market expectations, with its net profit rising by around 23%. And that was on the back of stable listing volumes and also higher prices.
That reaction on the day did seem a bit too positive, and the stock has come back a little bit in the days following. But this is a business with consistent, strong financial metrics. Return on equity remains above a very high 30%, and its net profit margins are still sitting at a very impressive 34%. It reflects REA's dominance in the online property listings market, which with a 75% market share. The company's pricing power, platform depth, and the customer stickiness allow it to grow even in a flat property environment.
Yeah, and looking ahead, Charlie, management did guide for further price-led growth in financial year 26, supported by stable property volumes, new product rollouts, and deeper engagement from agents as well. In addition, you've got the interest rate cuts coming through and also increasing migration, which should continue to support that housing market. And for financial year 26, return on equity is expected to remain solid at around 32%.
Yeah, that's right. But like most companies, it hasn't been a smooth ride. REA has had a few bumps this year. First, it walked away from a proposed $9 billion acquisition of UK property platform Rightmove, a deal that, if completed, would have added significant risk to that business. Then came the acquisition of Domain, REA's biggest local competitor, by US giant CoStar. That's raised concerns about stronger competition, with Domain now having deeper pockets to fund its growth. And lastly, the ACCC has launched an investigation into whether REA has misused its market power, particularly in its dealings with the real estate agents.
Yeah, it's also worth noting, Charlie, that the CEO, Owen Wilson, he's set to step down in early financial year 26 as well. So while internal succession planning is underway, leadership transition inevitably introduces a degree of uncertainty. That said, though, REA has a track record of navigating change without compromising too much on their performance given their market position. But again, this is a high quality business where short term volatility often creates long term opportunity. Its strong market position and business model that allows it to extract more value per listing through higher margin add ons, even in a subdued housing market environment. For now, though, investors should take comfort in the numbers, but monitor earnings revisions and short interest under Golden Rule 4 for any early signs of deteriorating sentiment, especially with regards to these risks. And now, with earnings season heating up, one question that is often asked by our members is which stocks are on our watch list for potential star stock inclusion? Well, a good starting point here is trying to identify those growth opportunities by referring to the Stock Doctor filter for potential growth stocks. Click on Tim's growth stocks with potential and sort stocks by its forecast return on equity and look for stocks with a return on equity of at least, say, above 14% and also positive forecast earnings growth as well.
Yeah, a few interesting names have popped up on our radar. That includes AV Tech Integrator, SKS Technologies, defense contractor Duratech, industrial services firm Tasmea, financial software provider Bravura Solutions, power infrastructure specialist Genus Plus Group, lab equipment supplier XRF Scientific, and parking tech platform Smart Parking. As always, it is important to ensure these companies meet our liquidity filters. For star stock consideration, we typically require an average daily traded value of at least $200,000.
And also, Charlie, for potential star income stocks, you can also refer to Tim's income stock with potential and then sort the stocks on a gross forecast dividend yield. Then select the stocks with stable share price performance and rising dividend growth as well to help you separate the sustainable yields from yield traps. Finally, ensure that the stocks have sufficient liquidity.
Yeah, and for income-focused stocks, we generally look for names with at least $500,000 in average daily traded volume to ensure adequate liquidity. Some potential candidates include Fuel Retail REIT, Dexus Convenience Retail, Property Trust Charter Hall Retail, marketing services provider IVE Group, retailer Harvey Norman, and advertising media operator Oo Media. These businesses typically have pretty stable cash flows and dividend potential. But as always, we'll assess their fundamentals more closely during reporting season. Alternatively, you can build your own filters using the forecast metrics. If you need help with this, feel free to contact our member relationship personnel.
Yeah, some good ideas there, Charlie. And that's all we have time for this week on Taking Stock. Thanks for joining us, and we'll be back next week with more insights as results keep rolling in. And so thanks for joining us, Charlie.
Yeah, and don't forget to tune into our Lincoln Live webinar on Monday if you have any questions regarding the results from the reporting season.
Yeah, and if you're looking for broader financial services, including wealth management, portfolio administration, accounting, or even access to alternative investments, we'll be more than happy to assist. Simply head to that Prime portal within the Stock Doctor platform to explore how our team can support your wider financial needs. Until then, as reporting season gains momentum, it's a timely reminder to stay disciplined, review your portfolio holdings carefully, manage risk thoughtfully, and avoid speculation. Wishing you a happy, healthy, and prosperous week ahead.